The stock which has done rather well for itself post-listing. The listing was not that exciting, but post-listing markets are realizing the value of the franchise is five-star business finance. It's a South-based finance company, enviable return ratios, brokerages across the board, HNI investors across the board have lapped up the stock quite aggressively post the listing. Let's connect with the management to understand that are these numbers, which are best in the industry in terms of the franchise they represent, are they here to stay? Can they grow their book at this kind of a run rate of 20% plus? Lakshmipathy Deenadayalan, Chairman and Managing Director of Five Star Business Finance, joins us now. Lakshmi, it's your first time I'm at least interacting with you on this forum, so nice to connect with you. I have a report, and I'm going to first refer to this Kotak institutional report dated 5th of Jan. Kotak is talking about a high growth of 30% in next 3 years, which means Kotak is making a case that they see the franchise as a potential to grow at least 30% on a CAGR basis for next 3 to 4 years. Do you think they will get it right? Do you think they will get it wrong?
Thank you, Nikunj, for having me in ET Now. Yes, I also read that report. I think 30% is doable. I don't think there's any challenge. Before talking about 30% growth doable or not, so I wanted to explain something about Five Star to your viewers. See, Five Star is positioned in a very niche market. This is very less crowded market where we lend to millions and millions of shopkeepers and self-employed. So Five Star caters to the market of millions, where these people don't have a underwriting credit for themselves. So it is not easy for any lender to crack like what we can crack in vehicle finance and gold finance, and obviously microfinance. So this segment is untapped by many lenders. So Five Star has been doing well for last 20 years, and market is huge. Anyone knows the opportunity of this market. So given this position to Five Star, growing at 30% year on year is not a challenge. We have been doing it very well pre-COVID. During COVID, we didn't grow because it was a conscious move not to grow during uncertain times. I think now the COVID's all settled. Now the growth is back in Five Star. I may say the September quarter, which got completed, and December just recently concluded, will be one of the best quarters for Five Star. Keeping that momentum in mind, growth at 30% is not going to be a challenge for Five Star.
Now, my follow-up question is that your return on asset is 8%. You are lending to borrowers who perhaps do not have, I mean, they'll come to you only if their loan is getting rejected from a bank or from some other NBFC. So in this case, are you not taking returns? Are you not taking higher risk?
Sorry, I think we are not targeting the NBFC or bank customers. Our target is very clear. We are disturbing the moneylenders market. So our market is between tier 3 and tier 6 towns, where the shopkeepers, self-employed and cash salary people, their first port of credit is borrowing from moneylenders, friends and families. That is where Five Star goes and breaks them and bring them to informal lenders like Five Star. So we don't compete with NBFCs and banks. So neither we take the files from them. So it is not the rejected files from other NBFCs and bank Five Star lends. We lend to a category of customers who have not been lent by any formal lender in this country. So we be the first port of credit to these customers at first go.
What is the collateral you get? Because the money lender, in a sense, sometimes they get a collateral, they don't get a collateral. What is the collateral you get from them? And I'm going to just supplement this one more point, that if I look at microfinance companies, they pretty much are also saying that, look, we are giving money to those who have been borrowing from small loans, but for those who've been taking money from money lenders and the kirana wala and from their brother-in-laws. How are you different when it is compared to the microfinance business?
Yes, definitely. Let me take the second question first. Because people have to understand, this is not a microfinance company. We are not a microfinance lender. The differentiation between a microfinance and a Five Star is, first is the quantum. We are lending sweet spot is between 3 lakh to 5 lakh ticket size, and microfinance they lend somewhere around 50,000 to 1 lakh. Second, it is fully secured book. we take the security of their property where the entire family lives in. So that's the primary collateral that we take from the customers. Third is our tenure is somewhere around 5 years to 7 years, whereas a microfinance tenure, average tenure will be around 6 to 12 months. So we are not a microfinance lender, so we don't compete with them, and neither they can't compete with us, because this is a model of underwriting. You have to underwrite the character, cash flow, and the collateral of the customers, whereas in microfinance, there's underwriting is not big in nature. So neither they or neither we compete with them. So this is a very unique segment. As I said, we cater to the customers who have been catered by money lenders for years and generations.
Mr. Deenadayalan, good morning. I wanted to also understand the outlook on your margins and ROAs. As we are seeing the liquidity in the system dry up, are you facing any challenges on borrowings and margins? And where do you see your net interest margins and ROAs normalizing in the near term?
Yeah, like what I said, Five-Star positioning in asset, comparing with other NBFCs and lenders, even from a liability side, Five-Star is very sweetly positioned, because our borrowing rate was around 11.5%. Today, our borrowing rate has come down to 8.75%. Because Five-Star is well capitalized and our profitability is very good, and our asset quality one of the best in the lending segment to these customers. So the risk underwriting by the lenders of Five-Star has come down. So our borrowing cost also has come down. So today I borrow at 8.75 to 9%. And even at the cost of fund at the book level, our cost of fund is around 10.5%. So incrementally, if my borrowing is also at 9% or 9.5, going up 50 bips, 9.5, we don't see any compression in NIMs and yields and spreads. So there is no need for Five-Star to transfer this, to increase the borrowing cost to them.
Okay, fair enough. So you seem to be in a sweet spot as far as that is concerned. What about your credit costs? Because for the last 3 financial years, they've been between about 0.8 to 1.4% roughly. Is there a specific process for the loan disbursals in terms of being geographically agnostic?
I think that's the important question, how Five-Star differentiates with other lenders. Our credit underwriting is very unique. We have been doing it for last 20 years. So we know the pattern of these customers. We know to assess the character. We know to assess the cash flows. And our collection model is put in place exactly suiting this profile of customers. So we enjoy one of the lowest credit costs in this market. I think going forward, we'll be in the same range of around 1 to 1.5% will be our credit cost going forward.
But at a time when banks are going all out to get more deposit franchise, and if your cost of borrowing is at 8.5%, and if banks are giving 7.5% to about 8% in terms of both short-term and long-term fixed deposits, you got competition coming up, sir.
So competition from liability, you're talking from liability perspective,
liability,
right?
Yeah, liability, pure liability, because liability will go to banks if they're giving 7.5% to 8%.
Yes. Yes, I got the point. See, that's why I said, Nikunj, our borrowing cost in the book is 10.5%. 2 years back, we have been borrowing at a slightly higher cost. That is benefiting us now. Now the borrowing cost has come down substantially, around almost 200 bips from where we have been borrowing 2 years back. Even though bank may increase as the rates are going up, even my incremental cost of borrowing for next 2 quarters is going to increase 100 bips. Will be somewhere less than 10%. So mathematically, 10.5 will come down to 10. So there is no need, there's no pressure from NIMs from Five-Star, and no need to increase the cost to the lenders whom we lend.
Are you also borrowing from the wholesale market, or you largely have your liability which is dominated by retail franchise?
So we are not deposit taking NBFC. Our liabilities are all wholesale. We borrow from banks and even from the markets.
So my next follow-up question is that if I look at the fintech world, I mean, I'm trying to draw a parallel here. A lot of fintechs are re-innovating a lot of way in which how the borrowing and the lending mechanism would move. You enjoy a very special situation. I mean, a very unique model, I must say. I've never seen a model like this, Could there be a disruption around the corner given that what fintechs are now trying to, evolve and achieve?
I don't see that as a risk, Nikunj, for two reasons. First is the market presence. Our market presence is, as I said, in tier 3 to tier 6 and tier 6, 7 towns, whereas the fintechs are stronger in tier 1 and tier 2 towns. So the market in which they operate and we operate is different. Point number two, their product is completely different. They lend to working capital. That means they can lend 50,000 to 1 lakh max. Whereas our average ticket size is 3 to 5 lakh to set up a business or to expand the business unit of the customers. Third, the tenure. Since they are unsecured lenders, they can lend only for a shorter duration, maybe 6 months to 1 year. Whereas Five-Star being a secured product, we can lend to 5 years to 7 years, where the EMI is sweetly positioned to the customers well. So I think keeping these three things in mind, I don't think Five-Star's business model will be challenged going forward.
The summary of our interaction, please feel free to correct me if my interpretation is wrong. What you're committing to us are three things. Number one, a 30% CAGR growth for next 3 years is achievable. Markets will consider this as a guidance. That's point number one. Point number two, even in a low rising interest rate environment and a liquidity tight environment, you don't see a risk to your liability franchise. And see the margins and the ROA what you have right now, you don't see any reason as of today whatsoever that they will go down.
No, Nikunj, I agree. Point number one and point number two, 30% year-on-year growth is doable by Five-Star. Second, I don't see any risk from a liability side because our rating is just gone up from A plus to AA. So we are a AA rated company with, as I said, good profitability and good asset quality in our books. Third is the important point. I think third, this ROA of 8% is not sustainable. We're very clear because that's coming from low leverage. As the leverage kicks in the sustainable basis, our ROA guidance, what we are giving is 6 to 6.5%, whereas it improves the ROE. Currently, our ROE, return on equity, is around 15%. That will go to close to 20% in next 3 years. So the game what we have to play is leverage ourselves and move the return on equity from 15-ish level to close to 20-ish level.
Deenadayalan, great to have you on ET Now, and look forward to more interactions with you.
Thank you. Look forward to.